Hi, I'm Max Lee, and I'm assistant professor in economics department at SF State. I teach a class on public economics, which has to do with the government's actions in the economy, in terms of both taxes and spending. So I thought it would be fun to talk about public policy around COVID when I was asked to do a presentation on it. Today, I'll first talk briefly about all federal responses to COVID and the economic crisis that came with COVID that Professor Silvera talked about. And then I'll talk about a couple of economic research that studied two of the main parts of federal responses to COVID, which are the stimulus checks and the extra unemployment insurance payments. Whoops. Okay. So these are the main responses to COVID that came from both the US Congress and the Federal Reserve. So if you remember, early March was when the number of cases started to get out of hand and local governments began to take actions by closing the economy down to reduce the spread and prevent hospitals from becoming overwhelmed. And this was also a time when we suspended in-person classes at SF State as well. And there were three big bills that came through the Congress to address this crisis during this time period. I'll talk about all three of those bills really quickly, and also talk about two of the things that Federal Reserve did in response to the economic crisis. And then I'm going to go into economic research and talk about the two of the most important parts, which are the Coronavirus Aid Relief and Economic Security Act, um, two parts of that CARES Act, which are the stimulus checks and unemployment insurance. So the first one I'm going to talk about is Coronavirus Preparedness and Response Supplemental Appropriations Act. This was around 8.3 billion worth of extra spending from the government that really focused on medical care type of issues. So it was responding to public health crisis. $8.3 billion seems like a lot of money, but in reality, it's actually pretty small compared to what the government usually spends on average. So in 2018, for example, the federal government spent $4.1 trillion. So this is less than half a percentage of spending that the government does in like regular basis yearly. On March 15th, the Federal Reserve set the interest rate to 0% and committed to $700 billion of quantitative easing, where both of these things are what we generally call the stimulus tools that the Federal Reserve can employ. So they were really responding to the economic crisis at this stage and trying to make sure that the economy stays afloat, even though all of these businesses were stopping their operations. And then on March 18th, the Congress passed Families First Coronavirus Response Act, which is the second of the three bills that Congress passed. In the second bill, the Congress aimed to help out people in acute need for assistance, so people who were sick themselves with COVID or other issues, someone who have a family member who's sick and they need to take care of that family member. So those two things are covered by paid sick leave and paid family and medical leave, which I think are the two of the more important things that came with the Family First Coronavirus Response Act that people should be aware of. So paid sick leave, paid wage replacement for up to 80 hours. So you could basically take advantage of this and not work for 10 days while you're sick. Paid family and medical leave, paid up to $200 of wage replacement for up to 50 days. So you could take actually a lot of time off in order to take care of your family or take care of yourself as well. So those were like two big ones in terms of Families First Coronavirus Response Act, but this wasn't the biggest bill. The biggest one was what we call the CARES Act, right? But before we get to CARES Act, I want to talk briefly about purchase of corporate debt that Federal Reserve started on March 23rd, because that's one of the more important parts of things that the Federal Reserve started doing. So they started this program that allowed them to purchase corporate debt, which is something that they didn't really do for other financial crises. Like they didn't even do it for Great Recession. So it's a pretty big game changer. So what does this actually do? Well, most firms function generally by borrowing money from investors that they need to repay at regular intervals. During the times of economic crisis, there is a huge decrease in demand for goods. People are just buying less things because they don't have money or they don't expect good things about the future, so they're going to cut down on spending and save money. So when that happens, the investors are starting to lose confidence in the firm's ability to pay back the loan. And that would imply that a lot of investors might drop out of the financial market, which means a lot of these firms are going to fail because they can't find some investor to come in and save them. Usually, this isn't a problem in regular economy or in a lot of cases in financial crisis as well, because when firms fail in a regular economy, that's not necessarily a bad thing. That just means that the firm that failed was a bad firm to begin with. So that firm failing and getting replaced by another firm that is perhaps more productive could actually be good for the economy as a whole. But in this case, that's not going to be true because a lot of firms failing are failing because they are suffering due to things totally unrelated to their own actions, right? So there are firms that are super healthy in normal times that are suffering all of a sudden. Like good example would be airliners. Airliners were doing fine before, right? But now because of COVID, people are spending less money on traveling by air. In fact, I wouldn't travel by air right now. Why would you? So in this case, airliners suffered not because of any of their own actions, but because of COVID, right? In that case, the Federal Reserve has a reason to come in and say, okay, we're going to actually help you out because none of this is your fault. And the least we can do is to try to buy the debt that you have so that you can be you can stay financed throughout this COVID crisis. And then on March 27th, the Congress passed Coronavirus Aid, Relief, and Economic Securities Act, or CARES Act as we generally call it. Under CARES Act, this was probably the biggest one out of the three bills that I talked about today. So CARES Act provided cash payment of up to $1,200 to not every American, but large portion of American population. It also provided additional UI benefits of $600, and they did also extra things like suspending the payment to federally held student loans and mandated private insurances to cover all COVID-19 related treatments and vaccines. But I'm really going to focus on the first two here because those are the more important ones to really think about in terms of the impact the government had on the economy. And there are actually good research that documents what kind of impact these policies had on the economy as well. So let's first talk about the cash payments. What this did was they provided up to $1,200 of tax rebate for individual filers and up to $2,400 for couples based on their 2018 or 2019 tax returns. And in addition to that, there were $500 of additional payment for each child aged 16 or under who were claimed as dependent. The caveat here is that only the people who are earning less than $75,000 for single filers and less than $150,000 for couple filers to receive that full amount of funds that were made available through tax rebates. For people who are earning up to 99K for single filers, for example, they received some amount of payment that's smaller than 1,200, and then for people who are earning in six digits, they weren't getting anything, right? So that's how they decided to structure this really to help people who are in the low income or middle class range rather than people who are earning a lot of money. And to think about how many people this actually affected, let's take a look at the distribution of household income in 2014, and the numbers probably didn't change by a lot since then. So if we look at this income distribution, the $75,000 maximum cap for single filers should fall somewhere around, I'll say 60th percentile. And for couple filers maximum limit, which is 150,000, would fall somewhat below 90%. which means that between 60 and 90% of all American households were affected by this uh, stimulus checks. They received $1,200 or a little bit less than that as some additional money that they could spend. So how did this additional money to spend actually affect the economy? How we're going to measure the effect on the economy is through looking at how much spending people did. So this is the same, the people who did this research are the same people who are behind the Opportunity Insight, which Dr. Suvaro talked about. So if we look at the slide here, from one of their presentations. Um, what I would like us to focus on first is the panel B. In panel B, we're looking at how the lowest income quartile, meaning the bottom 25% of US income distribution, people responded to this extra money that they suddenly had in their pockets. What we see before the checks were sent out on April 14th is that the amount of spending that people are doing were down relative to how much it would have been when if there was no COVID by between 10 and 30%. And it's important to notice that this is in downward spiral, meaning that the reduction in spending was becoming more and more severe as more and more people were losing their jobs during this time period. On April 14th, when the checks were sent, this actually bounced right back up, right? So if we look at the spending during later weeks of April, we see that the spending goes almost right back to what it would have been in the absence of COVID, which means there was a huge stimulus effect, especially for the people in the very low income range in the US income distribution. If we look at panel C, on panel C, what we're looking at is what happened to average spending for people within the top 25% in the US income distribution. For these people, they wouldn't have been affected directly by stimulus checks because they're not getting any money. They make too much money already. Instead, how they're going to be affected by the stimulus checks that are being sent to lower income individuals is that when the checks are sent, people are going to spend more money in general in the economy, which props up the economy as a whole. So one way you could think about that this would happen is that a lot of people who are within the high income quartile would be like business owners. And if people are coming to your business again and buying things, then you can actually get out of hole, get more money, so then you can spend more money yourself as well. The panel D shows us how that money was spent by especially the people in the bottom 25 percentile. What this shows is that if we look at the spending on durable goods, so those things are like home electronics, appliances, cars, things of that nature, spending on that increased by a lot when the checks were sent, which implies that people are still spending like a lot of money, probably their entire income, on necessities like food and rent and things of that nature. But when they got this extra money, they finally had money to replace that old appliance that they really needed to replace but couldn't because you didn't have any money saved up, or you could buy a car so that you can be more safe in the times of COVID. So apparently, it's really driven by the durable goods, how the bounce back in the in amount of spending that people are doing happened. And you might wonder, right? So, but Max, isn't this because the economies are opening back up? Well, that's true. The states were opening back up during the end of April and all the way to throughout May, right? So a lot of states opened back up during this time period. And that could potentially affect the economy. But according to the research that Chetty and Hendren and co-authors did here, it appears that states opening up didn't really do a lot. How do we know that? Well, we're going to compare states that opened up early versus states that didn't open up until later on. So example of that would be Colorado versus New Mexico. So if we compare those two states, because presumably those states are similar in a lot of characteristics. If we compare these two states, we see that the spending patterns move in exactly same direction, and there is not a lot of difference between the lines that Colorado follow versus New Mexico follows, even though Colorado opened back up its economy maybe 2, 3 weeks earlier than the New Mexico did. And also important to note here is that spending started to go back up in both the states that reopened and states that didn't reopen around the time that checks were being mailed, right? So that tells us that it's really about these stimulus checks and what the federal government was doing rather than what each locality were doing that affected overall economic welfare. And if we just compare like all the states that opened up versus states that didn't, we still see the same pattern between those two types of states. So this also shows that there wasn't really the effect that we expected almost of states reopening up faring better. It's actually that both the states that didn't open back up and states that opened back up are following same trend in terms of the spending that people were doing during this time period. And if we look at panel C, that's employment. So employment patterns didn't, diverge really at all between those types of states as well. So what that last slide tells us is that it's really driven by the stimulus checks that the government was sending instead of what localities were doing. But what about unemployment insurance? Did that have a large impact on overall economic well-being? We're also going to measure that by looking at spending that people were doing in the economy. To think about that, we need to first know how unemployment insurance usually works, right? So first here, we see that for different groups of people, they have different income levels, and unemployment insurance generally reflect that. Meaning, for regular unemployment insurance, the amount of insurance payment you get would depend on your income up to a certain amount of money. And because the point of unemployment insurance is to make sure that you can survive in the economy, even if you lose your job, so it gets kept to a certain amount of money that the government believes that you can survive on for time being. So then for people who are higher income than certain amount, all get same amount of unemployment insurance payments. So this would be generally how it looks. And what you can notice here is that for all of these different people with different income levels, they're all getting less amount of income after they get unemployed compared to before they got unemployed, right? When they had a job, they were better off. What CARES Act changed was that now, because we have this $600 payment to everyone, we're going to have something that looks like this, where some people who had low income are going to be paid more than when they actually had a job. Whereas for high income people, that's not true, right? They still lose money. What this means is that we can figure out how much of an impact unemployment insurance payment, the extra unemployment insurance payment through CARES Act had on the economy by comparing places that had large amount of lower income people. As a result, a lot of people gained because of CARES Act and unemployment insurance paying more than what they would have earned if they had a job, compared to places that were filled with these groups of people where people are still losing money, right? So then CARES Act extra payment did relatively little to these groups of people and relatively a lot for these groups of people. So this table is, if you know how to read this, go ahead. If you don't, then I can explain what these numbers mean. We are, in this particular case, only gonna look at the fourth column, okay? So what this number, minus 12.04, means is that when unemployment increased by 10%, the amount of spending that people were doing decreased by 12.04%, so about 12%, relative to if there was no COVID, right? So this appears that unemployment really affected amount of money that people spend, and that makes a lot of sense because you have less money to spend, you're not going to spend as much money anymore. But what's important here is this last row here. What this tells us is that in the places that were heavily affected by unemployment, but it was filled with a lot of people who were earning a lot of money back through unemployment insurance because they had lower income to begin with. In those places, there was really no effect on spending due to COVID. It was really only in the places where replacement rate was low, meaning people weren't gaining a lot of money through this extra UI insurance, that people were spending less. So this shows us that extra unemployment insurance had a huge impact. In particular, the researchers found that eliminating this extra payment would lead to 44% decline in overall spending. And if it was reduced to $400 instead of $600, like as it was in CARES Act, they estimate that spending would fall by 12%, which is still a pretty huge amount, even though it's not as big as the 44% decline that people predicted for getting rid of that extra payment altogether. So because Democrats and Republicans couldn't find a way to create additional bill that addresses COVID yet, so there was no second round of payment, and the UI extra UI payment benefits lapsed, meaning that they stopped paying that extra $600 per week. Um, so then the White House stepped up and said, okay, we're going to introduce an executive order to replace some of that $600 extra unemployment insurance payment with, in this case, $400 of extra unemployment insurance payment. And as we saw in the last slide, this most likely means that we would expect spending to fall relative to what it would be if there was no COVID, because the amount of extra UI payment that is being paid is decreasing. So people will generally have less spending money, which means that um, over time, we might see slowdown in the economy because of the lack of extra UI payment that people had before. So I think this is something to look out for moving through September and October as we get closer to the election, because, well, as people say, economy is important in elections. This year, there are so many other things happening. I don't know how important this actually is, but as far as this is fairly important, we would imagine that economy stopping its bounce back towards more employment and more spending across the income groups, that would actually affect the election, right? So that's something to look out for.